I would say the biggest misconception in the financial industry is what QE does, how it impacts the monetary supply, and if QE is money printing. Everyone has seen the headlines. The Austrian economists for years have been saying QE is increasing the money supply. It's creating massive amounts of inflation. And the more Keynesians and MMTers have been saying for the past few years that QE is just increasing liquidity and it does not increase the money supply. Who is right? What is going on? Because there's more misconceptions around this subject than I think any other in the entire financial realm. So is QE money printing? Hint, the answer is both yes and no, but the devil is in the details. So first off, we have to define how money is created. We're going to go over 3 different scenarios. First, everyone knows the main way that dollars are created are one, by bank lending. Banks lend money, and when that loan is created, money is then created. We're not on a fractional reserve system. We are on a complete bank lending, unlimited balance sheet standard. So any loan that is created, money is created. The second way, slightly less known, is if the Fed monetizes government debt. Easy way of thinking about it is the stimulus checks. The government issues a ton of bonds, the Fed comes in, buys those bonds, and boom, new dollars are now chasing goods and services because the government then steps in and spends those into the economy via stimulus checks, directly implementing them to the non-bank entities, aka me and you. The third way, and this is how QE can be inflationary, because the first two you needed. First one is just banks. Second one is just a hand and fist between the government and the Fed. But a lot of people think that happens a lot. It really doesn't. 2020 was kind of a special circumstance. To say the tide is most likely going in that direction is most likely correct. The third way is, this is how QE can be money printing, is if non-bank entities sell treasuries to the Fed. And I know what you're saying. What the are you talking about? It is if I hold treasuries on my balance sheet. What is that? When I buy a treasury, the M2 money supply would actually decrease. And the reason is because dollars are liabilities on a bank's balance sheet. So if I buy a treasury, that bank is now taking those dollar liabilities off its balance sheet, and now I'm a liability of the government. Why is this important? Because that is decreasing the money supply. Then if I then sell those treasuries, what happens? Those dollars now magically appear back on the bank's balance sheet, therefore increasing the money supply. So if the Fed is buying a bunch of bonds from non-bank entities, a lot more people are going to have currency units in their checking account than they had before.
Yeah. And I would say maybe kind of go back to basics in this regard and say, how many currency units in the real economy that are spendable currency units that are chasing however many goods and services there are? If you have an increase of currency units, you don't have a corresponding increasing of the goods and services. Well, the goods and services are going to cost more in currency units. This is supply and
the
demand.
Reason why this is even important is because you want to forecast inflation.
Yeah. But I would say there's a few caveats in all of this that you need to mention. So here's an interesting thought experiment. I'm not saying this is going to happen, but just walk with me here. If you were to suddenly wave a magic wand and through some, act of Congress or act of God, whatever, you were to airdrop $1 million into every single corporation's checking account, every single person's checking account, whatever, right? And at the same time, if nobody actually spent it, so the velocity of the money went basically to zero in the situation, that wouldn't necessarily be inflationary, because while there are more currency units that are potentially spendable, they are not actively seeking things to be spent on. So again, I'm not, obviously, I think if people had $1 million, you would see velocity increase relatively quickly. But my point is just conceptually, you have to have like this two-part dance, or as the old phrase goes, it takes two to tango. I think the same thing is true in this regard. And so, Josh, yesterday you and I we got into a pretty spirited discussion over this. And when it gets back into QE, the way I would think about it, so I would agree with all the 3 things you said, but maybe from a slightly different perspective, I would say, like, look, if the Fed is engaging in activities through whatever you want to call it, however many steps they want to take, at the end of the day, are Fed bank reserves being transmuted into spendable currency? That would be, or that is, bank liabilities. That would be kind of the way I would think about it. But I would also say there's 2 directions in time you can go through. And this is, I think, where QE, this is how I view it for the most part, is that QE basically allows a bank to restructure their balance sheet from by swapping out one asset for another asset. So if you think back in 2008, the example might be mortgage-backed securities or some other, collateral that's perceived to be impaired by the system itself. That goes off the bank's balance sheet, and bank reserves go back onto the balance sheet. That is what many people would call the printing of the money in that regard, where the Fed just types numbers into a computer. Now, I think Gammon made a point a few months ago where he said this is kind of already baked into the system because the money that was spent to create those mortgage-backed securities, so I work in real estate or whatever, right? Those deals have already been done. They were probably done years ago. So the effect is already in the economy. It's baked into the cake. But at the same time, you can also have things that go forward. And as you noted in 2020 is an excellent example of this. So think about the PPP, the Payroll Protection Program, and the loan forgiveness from that. If this ultimately was monetized by the Fed, and let's just pretend that it was for a second, the Fed could do it, but the Fed needed commercial banks to act as a handmaid, and they needed them to act as an intermediary. And it gets back into this concept of swapping one asset for another, in the sense that the banks would issue, commercial banks would issue PPP loans to businesses. So all of a sudden, the business now has more spendable units of currency they can spend in the real economy, and the bank has an asset that is the receivable, the note that is due from the PPP borrower back to the bank. And if the bank can then flip it around at no risk to the Fed, or ultimately to the Fed, and get bank reserves in the process of doing so, I would say that the Fed has still made spendable bank reserves, although with the caveat that they needed the handmaiding of the commercial banks to do it. And they might have had to back into it versus jumping into it.
That was also issued by the government. Like right in this case, it takes three to tango because the government had to come out and say the PPP loans need to happen. The Fed had to monetize it. The banks had to actually issue it. So there's a lot of caveats. I would say the big argument that once you kind of get into another layer of intellect, people kind of what Justin was just laying through is, okay, QE may not directly print money, but what it does do is it frees up all these banks' balance sheets and makes them it's throwing the band-aid on the wound. Now these banks, they're feeling good. Just one second. I'm just explaining the argument. Now these banks, because they got all these toxic assets off their balance sheet, now they can lend to their heart's desire. And Josh, to your point, what you were just saying, now like what you were just saying, the banks are going to make all these loans because they have the balance sheet capacity because of the Fed. Therefore, that's how the money is created. Well, my friend, I would argue a few different things. Okay, in 2008, when we were in complete collapse and the Fed comes in and they buy a lot of those toxic assets of mortgage-backed securities, absolutely. That is going to help fight off the massive deflation and potentially fight off the economic collapse that we most likely would have had. I would say another big part of 2008 wasn't just QE. I would also say it is changing market-to-market accounting, which is, you could say, a different form of financial engineering, which is basically just saying, okay, I bought these mortgage-backed securities at $2. Now, with market-to-market accounting, if that $2 becomes $1, you have to say that you took a 50% loss. But with market-to-market accounting, you say, oh, I bought this at $2. This is a $2 worth mortgage-backed security. Therefore, I don't have to mark any loss because I bought it at this price. Therefore, it's always going to be at that price on my balance sheet. And that had a much bigger impact than QE. You can kind of argue that intertwines, whatever. But to say that QE then freed up all these banks' balance sheets, and then they were able to make all these loans, that in theory, sure, that works. But QE did not fix the actual problem. And you're also saying that every single time the Fed does quantitative easing and buys these treasuries off the bank's balance sheet, those banks, that's like saying, these banks are saying, oh my God, I do not want these horrible treasuries on my balance sheet. All I want is bank reserves because then I can buy stocks. No, banks love treasuries. They actually have extreme value because let's just say, well, I know where you're going to go with this, Justin, but let's just say if you wanted to, if you're a bank, if you want to get funding, all you have to do is pose those treasuries or mortgage-backed securities in the repo market, and then you can get funding, no big deal. But to say that it's going to free up their balance sheet so they can make a lot of loans, let's just look at what the result was. Not what QE is supposed to do, because it's in theory, QE is supposed to free up these banks' balance sheets, therefore they can make more loans. But what was the result? We can see this is the trend line of loan growth, where these banks were, the Eurodollar system was just pumping out loans. The economy was great. Everything was going good. Where would loan growth be if we stayed on that exact same trend line? My guess it would be way up here, not the 17 trillion loans that we have right now. I think it would look much more like 25 or 30 trillion, almost double the amount of loans. And we can see PPP, there was a big jump up, but it's still pathetic compared to the rate of growth that we would have had prior to any sort of quantitative easing.
Yeah, so I guess this is kind of always gets back to my point as it goes. Think back to margin call with 2008. Banks don't want to be bag holders of impaired collateral. Now, it doesn't matter if the collateral is impaired or not. It just matters if it's perceived by their fellow banks as being impaired. As Josh, you and I have also talked about before, who's the only person that can call bullshit on the system? Well, the regulators can to an extent, but regulators are slow. But it's the other banks. The other banks can call bullshit on the other banks. And if there is the slightest hint that one of the large banks might have a collateral issue where you have this impairment on the balance sheet, then yeah, you would want to restructure the balance sheet to take it off. And while, yes, a bank with a stronger balance sheet could, in theory, make more loans. I don't deny that point. A bank with a stronger balance sheet is also probably less reluctant to call in notes or loans they could otherwise call in, especially if those loans are performing. And so when I think about QE, I just think in terms of, a pretty narrow scope of saying, okay, well, listen, this basically allows the bank to take an asset off its balance sheet, that otherwise might be impaired or being perceived as impaired, even if it's not necessarily really impaired in reality. The mortgage-backed securities are an interesting example of this, because if you ignore mark-to-market accounting, so for example, if you're a firm that says, hey, listen, I'm buying this as collateral or just to park money in, I have no intention of selling, this 10-year bond before expiration. And upon redemption, the government, the U.S. government will guarantee me the face value of the bond. So even if it, even if interest rates rise and the face value, and the value of the bond goes down in the interim, who cares? It's not like I'm trying to sell it or whatever, right? It's when you have a accounting change that would force a bank to do it, or where you have a bank that has to take a paper loss, even though arguably from like a conceptual framework, from like the philosophic or from the philosophy of accounting, it doesn't make sense for them to do that in this particular situation, then you're going to run into issues. But again, I guess when I just simply think about it, it all boils down to, does this or does this not make the bank's balance sheet appear stronger or less risky, particularly to their fellow peers? And Josh, I made this point last night talking to you, that if you have a bank that's trying, regulators are always playing catch up. What's the phrase? Regulators are always archaeologists, trying to unwind and trying to figure out what the last crisis was. And I certainly think a bank, especially a clever bank, with a good compliance department, and just remember, a bank's compliance department is there to help the bank break the law, not stay within the law, or break the law by staying within the letter of the law, even if it's not the spirit of the law. If you have all this stuff going on, yeah, they might be able to circle and run around the regulators for the time being, but they probably won't, or it'll be harder for such a bank to run around their other banks, because those other banks are probably doing the same thing and they're just as effective with, any other bank. And so it's one of those things.
Justin, can I just expand on that for 1 second? Because I think that goes on to the next form of argument that I would then receive. Okay, Josh, the reason why this bank lending has fallen off a cliff is not because QE doesn't free up the bank's balance sheet. It's because of Basel III, the SLR ratio. All of these new restrictions on the banks are posing them to not make loans. In theory, okay, now we have a 10% reserve requirement. Great. But how do you get around that? As Justin was just saying, it is very, very easy. I'll give you a technical example right now. Let's say you're a bank in the United States and you want to make a loan for $1 billion, but your 10% reserve requirement is not allowing you to. What can you do? Well, you could do some financial engineering with a subsidiary bank, which is basically a bank that you own in London, because London doesn't have any Basel III requirements. So you could just flop you could take out a loan from that subsidiary bank, freeing up your balance sheet capacity, therefore reducing your reserve requirement. There's millions of other ways that banks can get around this. So to say that these Basel III and SLR ratios are significantly decreasing the amount of loans that banks make, I don't buy it. It's because banks do not see the profit incentive to go into the market and actually make these loans, because there's a structural issue within the economy.
I think that's too much. That is far, or in my opinion, that's far too large a conclusion to jump to. I think in the question of QE, you just keep it incredibly narrow and incredibly tight. Does this or does this not make the bank's balance sheet more stable, or at least appear less risky? And to finish the question, specifically in regards to their fellow banking peers. See, if confidence is the true reserve asset, of the system, and I think that it is, then anything that would impair confidence would be a headwind for banks extending credit. Now, if you want to make a structural argument for the economy, great, whatever. My attitude on that front is maybe it is, maybe it isn't. But in terms of the financial engineering side of the equation, I think that the way I would say it is that QE, just like any financial engineering tool, will open or has the potential to open the door to either banks extending more credit. And remember, by just the narrowest definitions here, if banks just extend 1 extra cent of credit, it's going to be inflationary. Now, you could say that's obviously not material, completely agree, but just conceptually here. Or the other option is to look at the other direction, that if a bank does not call in a loan that they otherwise would have called in because they feel that their balance sheet is currently strong enough to support it, then that's the case too. And as far as banks, looking for a new business or not to make loans, well, maybe yes, maybe no. But again, like I say this kind of like from what I've seen, is that especially when you're dealing with the small and regional banks, they're no, actually, I'll walk that back. I've never been on the other side of the table. I've never been a banker for all intents and purposes, at least at that level. So I'm not going to comment on how banks view the macro environment, but I would comment in that banks do fear regulators, but I think banks can run around regulators, and I think banks also fear their loss of confidence by their fellow peers, and I think that banks are much better at calling bullshit on other banks than regulators. Regulators will in time. Once the crisis happens and they can circle back and figure out what's going on. But as far as banks calling BS on other banks, I mean, Josh, consider what's going on with the Swiss National Bank swap lines for dollars or whatever, right? That's financial engineering, because there's some bank or some set of banks, that are worried about how they're going to look to their peers. And here's the irony of it. It might be a problem that's just that's conjuring up itself. Like, again, mortgage-backed securities. Wang's mentioned the fact that even though when those special purpose vehicles that bought up the mortgage-backed securities finally sunsetted, the government made a profit from it. And so this gets back to this thing where if you would just keep it on your balance sheet and say, okay, yeah, at the end of the day, the government's going to guarantee this, or that is, if you have a treasury bill or whatever, right? Yeah, sure, interest rates might have suddenly spiked and the value of this collateral would be down right now if we were to sell it, and therefore we would take an impairment if we sold it, but we're not planning on selling it. And we have no intention to sell it, and we're going to hold it to maturity. And if you think the U.S. government's not going to pay out in however many years, well, okay, that's another topic of conversation. But there's probably far bigger problems we've got to worry about if that's going to be the case than a short term or a mark-to-market loss when we have no intention of selling.
Yeah, so I think QE is much more of a deflationary fighter than an inflationary driver.
But are those the same thing?
No, I think it fights off deflation pretty good. Like, let's say we would have had massive deflation. I think it's pretty good at fighting off that deflation, but it's not really causing too much additional inflation. What causes real inflation is a lot more dollars coming into the system. I think the reason why I think it fights deflation is because there would have been this massive amount of contagion and probably combustion. But the Fed comes in, they kind of artificially prop that up, allowing these banks to continue to go on. And them continuing to go on is anti-deflationary, but they're still not going to take as much risk as they otherwise would have prior to 2008.
I definitely think I would agree with that.
So what could cause more inflation? It would be if we see more stimulus checks, if we see the government and the Fed coming hand in hand and issuing more dollars that actually chase goods and services.
Yeah, but see, I really bicker about talking about that. What causes inflation is that there's more potential spendable currency units in the economy that are being spent, or you could say it's the same number of currency units, but the velocity is increasing, or maybe there's less spendable units. Banks have called in, their loans, so they shrunk the money supply, but the velocity has increased.
So do you disagree with Milton Friedman that inflation is everywhere and always a monetary phenomenon?
Don't have enough opinion to say one way or the other.
Right now you're arguing against it by saying by arguing velocity, whereas someone like Jeff Snyder would say, okay, well, you just have to look at the dollar supply and to see where inflation is going to go.
I think back to that silly example I said earlier today.
But
if you were to air, no,
because it doesn't happen.
If you were to airdrop $1 million into everyone's account, then declare a bank holiday, I bet you'd see velocity be zero. Now, granted, you have a structure coming in and imposing order on the system, but that example might be a bit silly. But let's consider another example. Let's say banks suddenly start calling in their notes or calling in their loans, and so you're shrinking the money supply. And then let's say that also spooks the economy. So instead of velocity dropping to zero, velocity goes on overdrive. People are just spending whatever little they have or whatever, right? I would say that I think is a more plausible scenario than $1 million being airdropped and not.
But there's no new dollars getting into the system. So
Josh, full stop. You do realize that if you're spending the same dollar more times in a day, that creates that increases the money supply. You do realize that, right?
You can only do that for so long, though. Like, that is a very, very short-term solution. Like, do you think that's going to continue for years and on years on end, where people are just spending money as fast as they can, therefore velocity stays so high if there's no new dollars get?
I would be surprised if it continued for eternity. I guess my point is this: like, you this is why I think it's really, really important to like isolate in and like, be very, very specific with language in this regard. And so my point is that when people go to like these single variables, like if this then that, well, maybe, but I think there's a lot more nuance in this equation. And again, like I said, well, I certainly be the first one to concede my example of, $1 million, velocity going to zero doesn't make sense. I do think the monetary supply shrinking, but velocity picking up in excess of how the monetary supply is shrinking. So you still have more goods, you still have more currency units chasing the same, or let me think how to say this. The velocity increase offsets the decrease of currency units. And moreover, that's on the demand side. And there's not a corresponding increase on the supply side to keep up with the current units that are seeking, although they're being juiced right now through velocity, goods and services. That's I think the take. And haven't other people said that the thing that Milton Friedman got wrong was he always assumed velocity was zero? I mean, I've never really
He always thought it was constant.
Constant.
But the problem is we physically cannot calculate the monetary supply because of the Eurodollar system, and we have no clue how many loans have been created and how many dollars there are. So I don't know one way or the other. I mean, I honestly I'm in your camp. I have absolutely no clue where to judge velocity in that term. But what is much more important, instead of looking at velocity, is the actual monetary supply, because velocity is not going to change from 0 to 100 for a long period of time when you're trying to judge inflation. All right, guys, this was probably the most boring video you have ever watched.
Hey, I've got comments. Comments.
Yeah, I do too, but we've already gone for like 25 minutes.
Okay, so to say it on that, like, no, I think that velocity we just can't say velocity doesn't exist, or that it can no longer exist into the future, or that we should completely discount it. Now, I don't know how to price it into the system, but I just simply know that it's the height of hubris to assume that we've got this knob over here changes that thing over here. You pull this lever and that does whatever, right? Well, it might in the general sense, but you've got to go through and say the entire equation. I mean, Josh, I used an example last night. It's like, let's say you're trying to put on weight at the gym to gain muscle mass, whatever, right? You might need to, numbers on my backside here, 2,500 calories or whatever, right? So you say, oh, I need to eat 2,500 calories a day or whatever, right? Okay, you are correct, but you need to say the entire thing. Of those 2,500 calories, I need 60% to be protein, 30% to be or whatever, right? Like you've got to say the breakdown, because you can have 2,500 calories, but you can have the wrong kind of calories and not get the result you're wanting, even though you're technically correct when you need the $2,500 worth of calories. I think it's the same thing true when you look at economics in this regard, where you've got to be really, really careful to say the entire sentence, because I think people will throw around these terms and these phrases without, and they demand more of the phrases, or they're asking a level of precision from these concepts than the language they use affords, if that makes sense.
Yeah, so does QE print money? It is very, very nuanced. QE hardly ever directly increases the dollar supply, but it can indirectly do it. People drastically increase or overstate how important QE is, when it does not do too much. Compared to the effects that most people say that it has. In reality, it is pretty minuscule.
Yeah, be very suspicious if somebody says QE is money printing. It might be, but ask them to show their work and tell you why.
Yeah. Very few people understand the nuances of when QE is and is not directly implementing money. So, guys, very boring video. I doubt there's a single one of you guys to their end. If there is, make sure you tell Justin how beautiful his bald head looks. Thank you, and we'll see you in the next one.
Oh, one final comment too. Let me just go ahead. I'm about to get to level 17 here in Pillars of Eternity. That is inflationary, by the way. So